Welcome back. In this session, I'd like to look at some real-world applications in investing in finance of relationships between data. Now you're saying, where would I need to do that? Pretty much everywhere. In finance, we're constantly faced with questions of, hey, do two variables move together, either at a macro level or at a micro level? As an example of a macro level relationship, think of interest rates and inflation. The conventional wisdom is when inflation goes up, interest rates go up. But you can look at the data to see if that's true. Do interest rates and inflation move together? As an example of micro variables, does a company's operating margins improve or drop off when revenue growth goes up? You can look at the company's history to see if that relationship exists. Now, before you actually look at a relationship, though, you have to be clear about why you're doing it. You're saying, what do you mean why I'm doing it? Well, there are two reasons you might look at two data variables to see if they move together. The first is because you want to understand the data better for analysis. Maybe you're doing research. But often in investing in finance, you have a much more pragmatic reason for looking at relationships. You want to use one variable to forecast the other in prediction. Why? Because you hope to make money off that prediction. So let's take a look at a few examples of data relationships in investing in finance and see how the data play out. Let's start with the way we think about risk in finance. Now, if you've never taken a finance class, you probably haven't seen this model, but that doesn't matter because much of what I'm going to do doesn't require that as a prerequisite. But one of finance's most widely used and misused models is called the capital asset pricing model. I won't bore you with the derivation, but here's what the model says. It concludes that the risk of an investment is the risk added on to a market portfolio. In other words, it looks at the risk of an investment through the eyes of an investor who holds a diversified portfolio. You're still saying, I don't know what that even means. That's okay. The way we measure that risk, though, in the capital asset pricing model is by running a regression. There, I told you there's a reason I'm looking at this. You run a regression of returns on the stock against returns on a market index. If you've ever taken a finance class, you've probably seen this regression. Finance, we act like we invented this, but this is a statistical tool. We use a regression to estimate the risk of an individual stock. So what I'd like to do is actually take you through the statistical aspects of this regression. Later on, when we get to finance, we will use this regression. We'll talk about the economic consequences, but let's think of this purely at a statistical level. What you see on this page is a scatter plot of returns on Disney on a monthly basis from 2008 through 2013 and returns on the S&P 500. Let me get practical. Here's what I did. I took 60 months of data on Disney and 60 months of data on the S&P 500. I looked at the returns every month. So basically, I had 59 months of returns. You need 2 months, the first 2 months. You lose the first month when you do this. 59 months of returns on Disney and 59 months of the S&P 500. So the way to think about this is in February 2009, I had returns on Disney in that month and returns on the S&P 500 in that month. Now returns, of course, include price appreciation and dividends, but I do this for every month. In the scatter plot, here's what I do. I take each month and I plot the pair of observations. February 2009 is 1 point. March 2009 is a second point, and so on. So there should be 59 points in the scatter plot. And I have my best fit line. Remember, the best fit line comes from minimizing the squared distances. Now, I didn't do the dirty work myself because I drew on a statistics package to fit the best fit line. So there's the best fit line. And there's the output from the best fit line. I'll come back and address what that output is telling us in far more detail in a couple of pages. So Disney and the S&P 500 for 59 months. Now, before we look at the regression output, though, let's look at those two measures we said we can use to look at how two variables move together, the correlation and the covariance. Let's in fact start with the covariance. I know it's to the bottom. Let me start with the covariance. The covariance is a measure of how Disney and S&P 500 move together in the 59 months that I looked at them. The covariance between the two is 0.00337. So that's basically the shaded number. If I stopped right there and asked you, What does that tell you about Disney and the S&P 500? The only thing you can tell me is that they move together, not in opposite directions. But if I then asked you if 0.0337 is a high number or a low number, you're going to say, I really don't know. A correlation coefficient fixes that problem. It takes covariances, which are non-standardized, and standardizes them. In what sense? Correlations are bounded between +1 and -1. In this case, the correlation between Disney and the S&P 500 is 0.85666. Now, like everything else in statistics, that is an estimate. And like everything else in statistics, when you have an estimate, you have a standard error. So the standard error in that estimate is 0.00459. You're saying, what is that T statistic below? A T statistic measures whether the number you've come up with is significantly different from zero. You're saying, but I know 0.8566 is definitely different from zero. Well, statistically, you can never be sure. In this case, that T statistic of 12.65 tell me it's significantly different from zero. You're saying, how do I know whether 12.65 is a high or low number? A T statistic comes from a T distribution, which is very much like a normal distribution. Remember, once you're beyond 3 standard deviations, you're well beyond the realms of chance. In this case, you're well beyond, you're 12.65 standard deviations away from zero. Definitely, Disney and the S&P 500 move together more often than they don't. That's a correlation and the covariance. Now, what I'm going to do is look at that best fit line, the regression. And I'm going to break regression output apart, because when you use a package, all of this will show up as part of the output. And I want to make sure nothing is a black box. So let's start at the top. It lists the dependent variable is return in Disney. That's your Y variable. And the return in the S&P 500 is the X variable. You're saying, does that matter? Can I switch? It does matter. In this case, my dependent variable is the return in Disney. My independent variable is the return in the S&P 500. The correlation is 0.85666. You saw that already in the previous page. But if you square the correlation, you come up with what's called R squared. And R squared measures the goodness of fit. How good is this regression? So obviously, if the correlation is bounded at 1, the R squared is also bounded at 1. You want a high R squared. 0.73386. That's my R squared. You're saying, but what's that adjusted R squared below it? An adjusted R squared takes the R squared and brings in 2 other factors. One is, how big is your sample? The larger your sample, the closer your adjusted R squared is going to be to your R squared. The second is, how many variables are you using to try to explain your dependent variable? The more variables you use, the smaller the adjusted R squared will be relative to the R squared. In other words, what the adjusted R squared does, it penalizes you if you start adding independent variables just for the sake of adding independent variables, and penalizes you if you have a small sample. An R squared you get from a small sample and lots of independent variables. Don't be surprised to see the adjusted R squared be dramatically lower than the R squared. Now, right below the R squared and the adjusted R squared, you see what's called a Durbin-Watson statistic. Again, we could delve into the depths of Durbin-Watson statistics, but you don't want to do that, and I don't want to do that. Let me tell you what it's trying to measure. The Durbin-Watson statistic tries to measure whether your residuals are well behaved. Remember, when you have a good regression, your residuals shouldn't be correlated across your sample. There should be no autocorrelation. So basically, the Durbin-Watson statistic measures, so what am I looking for? You're looking for a number close to 2. That's your sweet spot. If your number is well below 2, then you're positive autocorrelation, which means as you go through your sample, your residuals are correlated with each other, which is not good for your regression. If your Durbin-Watson is much higher than 2, it can be as high as 4, then you have negative autocorrelation. So far so good, right? Let's keep going down. The next section of the output is called an ANOVA, an analysis of the variance, a fancy word for how much of the error in your regression is being, how much of the variance in your dependent variable is being explained by your independent variable. So first thing we're going to focus on is this item called sum of the squares. So notice that there are 59 observations in the regression. I told you why, because I'm looking at 5 years of monthly data. The regression is the DF refers to degrees of freedom. Because I'm using only one independent variable, the regression uses up 1 degree of freedom. Now later when we look at multiple regressions and you see me using 3 or 4 or 5 independent variables, you see those degrees of freedom go up. The residual is whatever left over. So if I have a sample of 59 and I use only one independent variable, then I have 58 degrees of freedom in my residual. The sum of the squares explained by the regression is 0.25276. You want your regression to explain as much of the error as you can. So you want that sum of the squares explained by a regression to be a high number relative to the total. The residual sum of the squares tells you what you cannot explain. So in a perfect regression, if you had an R squared of 100%, the residual sum of squares will go to 0. The regression will explain everything. You'll almost never run into a regression like that, but think of that as your limiting case. So what's the F value? The F value tells you collectively how much your independent variables are adding to the predicted value. So if you're running a regression where your independent variables are doing nothing for you, that F statistic is going to be a really low number. So a high F statistic means your regression is explaining a high percentage. You're saying, how do I know whether the F is high or low? Well, right next to it, you see what's called a p-value. The p-value gives you the probability that your regression is basically noise. It's explaining nothing. So if you get a high p-value, that means you might as well abandon the regression. In this case, the p-value is 0, which basically means there's a 0 chance that this regression is pure noise. Therefore, the independent variables are doing something in explaining your dependent variables. Let's look at the output from the regression. First, you have the coefficients. The first is you have a coefficient on what's called the intercept. That's where your best fit line crosses the y-axis. So if you look at the coefficient, it's 0.00712. So think of that as what Disney would earn as a return if the S&P 500 does absolutely nothing. Now, should I get too excited about that coefficient being different from 0? Well, that's where the standard error comes in. The standard error is a way for me to check whether the coefficient is statistically different from 0. And with that coefficient of 0.00712, you'll notice that my standard error is 0.00519. I know I'm throwing numbers at you, but that standard error plus or minus, so if you take the coefficient, add or subtract out two standard errors, you get a range on the coefficient. And guess what? I cannot statistically reject the hypothesis that the intercept is 0. Which means if you ask me what will happen in a month where the market does nothing based on this data, my answer is, I couldn't tell you. It could be, the number is close to 0, close enough to 0 that I cannot reject that hypothesis. In fact, if you take the coefficient and divide by the standard error, you come up with the t statistic. Again, I know I'm throwing a lot of things at you, but a t statistic, as in the previous page, tells you, when we talked about correlation t statistics, I said you want the t statistic to be a high number if the coefficient is different from 0. With the intercept, that t statistic is less than 2. 2 is like the magic number. I mean, you could get away with 1.5. But in this case, t statistic 1.37, very marginal. So what does it tell me about the intercept? I cannot reject the hypothesis that basically the number is 0. So in fact, if you look at the t statistic and the p-value, they basically measure whether a coefficient is statistically different from 0. With the intercept, the answer is no, it's not statistically different from 0. But in the case of the coefficient and the return of the S&P 500, you get a very different result. You get a slope of 1.25. You're saying, what does that mean? If the S&P 500 is up by 1%, at least based on this period for the regression, Disney was up 1.25%. It went up by more than proportionately to the market. With the standard error that I get of 0.098, I get a range on the coefficient of between 1.05 and 1.45. Which means that if you ask me what the coefficient is, if I were telling you, giving you the answer honestly, I'm not going to give you 1.25. I'm going to give you a range between 1.05 and 1.45. And then if you ask me, is that number significantly different from 0? I'm going to look at the t-statistic and say it's definitely different from 0. So the t-statistic and the p-value measure whether the independent variable is adding predictive value. You're saying, wait, isn't that what the f-value is also measuring? When you have a simple regression, all three numbers are going to move in tandem. You have a high f-value, you're going to have a high t-statistic, and a low p-value. Basically, the p-value is the probability that your number is actually 0. So the t-statistic, the p-value, and the f-value in a simple regression all are reading off the same page. They're telling you whether your regression has statistical significance. So now you know how to read a simple regression. So let's take a second example. In this chart, I've looked at 3 series. The first is what's called the earnings yield. It's the earnings of the S&P 500 divided by the level of the index. You know, if you're familiar with PE ratios, it's the inverse of the PE ratio, earnings to price. The T-bill rate is a short-term rate for US Treasuries. It's a 3-month rate. The T-bond rate is a long-term rate. It's a 10-year rate. If I just gave you those 3 charts and said, does it look like they move together? Well, just looking at it, you can see the 3 charts seem to, at least for the most part, move together. But your eyes can deceive you. So let's look at the covariances and the correlations. Now remember, there are 3 variables here, not 2 anymore. So when you look at covariance and correlations, you have to look at pairs. So obviously, if you look at this is called a correlation matrix. So look at the matrix first. Across the diagonal, earnings yields are perfectly correlated with earnings yields, and T-bill rates with T-bill rates. So that's why you see 1s. So you can ignore the 1s. But let's focus on T-bill rates and earnings yield. The correlation between those two is 0.61862, and the covariance sends the same message, it's positive. But with the correlation, I've given you the standard error and the t-statistic, definitely different from 0. Earnings yields and T-bill rates seem to move together. When T-bill rates are high, earnings to price ratios are high. Same message with the T-bond rate. In fact, since we have the data, we can also see that T-bill rates and T-bond rates also move together, and they move together even more strongly than stocks or earnings to price ratios move with T-bill and T-bond rates. The correlation is 0.93175. I've basically also taken those numbers and given you a p-value, which really you don't have to, because you can see that the t-statistics are so high that there's 0 chance, given this data, that you can claim that there's no relationship between stock price, stock earnings to price ratios and interest rates. Now, I wanted to run a regression, and initially I wanted to run a regression of earnings to price ratios against both T-bill rates and T-bond rates. It's a multiple regression, right? But you know what stopped me? Remember, the correlation between T-bill rates and T-bond rates is 0.93. You're saying, so what? Remember the lesson of multicollinearity? If you take 2 variables that are very highly correlated and you throw them in as independent variables, you're playing with fire, because they're sending the same message. Might as well pick one. In this case, I'm going to pick the T-bond rate. Why? Because its correlation with earnings yield is a little higher. And I ran a regression, in this case the scatter plot, of earnings yields against T-bond rates. Again, you see the plot. There should be 1 point for every year of data. And there's the regression output. The coefficient is 3.46, which means that if the T-bond rate dropped to 0%, which it never has in this period, the earnings yield is going to be 3.46%. Every 1% increase in the T-bond rate will increase my earnings yield by 0.53%. Let me give you a very simple way you can think through this. T-bond rates in 2021 are roughly 2%. 2% times 0.53 is 1.06%. You add the 1.06% to 3.46%, you will come up with 4.52% as your predicted earnings to price ratio if the T-bond rate is 2%. So you can then compare to the actual earnings to price ratios, and that's where the predictive power of these models comes in. You are dependent on past history, but you're using it to make prediction. So here's my final piece of the puzzle. I took that regression, and you saw the summary, and I wanted to make sure that the regression was not being driven by chance. My correlations and covariances already tell me something about what I'm going to find, but it's still reassuring when I look at, again, I won't go through the full details. You'll see the R squared and the adjusted R squared. Remember the lessons about adjusted R squared. The sum of the squares explained by the regression. The regression explains a great deal more than the residuals, which is good. And if you look at the output from the regression, you see the expansion of what you saw on the previous page, which is in addition to the coefficients, I've also given you the standard error, which then allows you to compute the t-statistic, and the t-statistic, as you can see, is clearly significant. So the T-bond rate is 2%, the predicted earnings yield is 4.52%. The actual earnings to price ratio on January 1st, 2021 was 3.68%. You're saying, what do I do with that? To the extent that you trust this regression, the earnings to price ratio is too low, which is the same thing as saying the price is too high. Stocks are overvalued. We've taken a regression and used in prediction. Now, of course, when we talked about regressions, we talked about regression diagnostics. And one of the diagnostics is, are the residuals close to normally distributed? So I did that. I'd done Q to Q plots in the previous session. P to P plots do pretty much the same thing. They look to see whether the regression is pretty close to normality. So remember, again, in a perfect regression, every point will fall on the line. This isn't quite perfect, but it's close enough that I can get away with using the regression. Let's do a third example. This is European banks in 2013. And with banks, one of the ratios you use to decide whether a bank is cheap or expensive is the ratio of its stock price or market cap to its book value. Book value is what the accountant tells you the bank is worth. The price is what the market tells you. So if you're an investor, the conventional rule is you want to buy low price to book stocks. So I have a bunch of banks here, and I've ranked them from low price to book to high price to book. So if you just picked based on price to book ratio, the stock you would load up on is Biorishi Hypoinverance, which I can't even pronounce it. But its price to book ratio is 0.80, low price to book, right? But just to slow you down, I've added two other variables. One is, what kind of return on equity do these banks, how profitable are these banks? You want a high return on equity if you want a profitable bank. And already you can see one of your problems with Biorishi is it's a very unprofitable bank. That should slow you down. I've also thrown in a measure that tells you how risky banks are in terms of standard deviation stock prices. A very high standard deviation means you have a risky bank. See, here's the quandary we're in. The stock looks cheap, but it has low profitability and high risk. Now, the problem with eyeballing the data and telling stories is you can talk yourself into a corner. Classic setup for bringing in regressions, right? And here I care about both return on equity and risk. So I tried a three-dimensional scatter plot. You got price to book, return on equity, and standard deviation. Each of these points is, so I take each bank and plot it out. Is there a relationship there? It looks like it, but no, scatter plots, there's only so much you can do by just looking at the plot. So I tried a correlation matrix across the three variables. And here's what I saw. Price to book ratios are very positively related to return on equity. High return on equity companies have high price to book. The correlation is 0.868. And again, clearly statistically significant. Price to book ratios tend to move inversely with standard deviation. High risk banks have low price to book ratios. Negative correlation, again, statistically significant. Now I'm going to run a regression with both return on equity and standard deviation, but here's one worrisome aspect. Return on equity and standard deviation do have a negative correlation. Correlation should be zero if this were a perfect regression. Clearly that's not zero. So let's see what happens if we run a multiple regression. Again, when you think about a multiple regression, the output looks very much the same with a little quirk that you can add on. R squared and adjusted R squared here, again, the difference is because of the number of observations. I have a small sample of 17 and I'm using two independent variables. So you'll see the difference between R squared and adjusted R squared is a little bigger here than in the previous regressions. Again, the way you read the squared errors is very much the same. You want the regression to explain the bulk of your variation, and it does. 5.47 out of 6.68 is explained by the regression. The F value is clearly significant, 33.92. What does that tell me? The two variables put together are clearly bringing in predictive value. Here you can have the F value deliver a message that might be different than what you're getting on individual coefficient, because it's telling you what the overall multiple regression is doing, how well it's doing in terms of adding predicted value. So it's saying the multiple regression works. But I have to check whether both variables are doing the work, or whether one is doing the heavy lifting, the other is on for the ride. So here's what I do. I'll skip the intercept, just like in a simple regression. The intercept tells me what the price to book ratio would be for a bank with a 0 return on equity and a 0 standard deviation. A hypothetical doesn't even make sense, but that's what it says. But let's take return equity. Every 1% increase in return equity increases my price to book ratio by 0.036. Is that statistically significant? Yes. 3.31 is clearly higher than 2. And you can see the T statistic and the p-value both tell me that the return equity is statistically significant and adding to. So when it says reject, I'm rejecting the hypothesis that the coefficient is really 0. What about standard deviation? The coefficient is minus 2.67. Every 1% increase in my standard deviation at a bank reduces its price to book ratio by minus 0.027. Again, statistically significant, minus 2.32. The p-value, again, conveys the same message. But here's the way to think about it. The F value that you see under the ANOVA tells me whether the overall regression works, but I still need to check the individual independent variables to see if each of them fits, because I might have 5 independent variables and 3 might be significant and 2 are not, and I will actually make my regression better then by removing the 2 that are not adding to my statistical significance, because the T statistics are well below 2. So you can already see the link between sample size and independent variables. You have to be very wary of small samples with lots of independent variables. If you have 25 observations in your sample and you have 5 independent variables, you're asking for trouble. My very simplistic rule is for every 10 to 20 observations, I get 1 more independent variable. So if my sample size is 100, I can have 4 or 5 independent variables. But my sample size is 10, the most I can get away with is 1 independent variable. And even there, I might be pushing it. Now, I use that regression to actually get predicted price to book ratios, because remember, that's the end game here. If you take each of the stocks that you saw listed on the previous 2 pages ago, and you use the regression to get your predicted value, you can see that I get a predicted value that's not exactly right on each one, and I compute the residual, the difference between my predicted and actual values. You're saying, why are you doing that? Remember, when you do a regression, you want to make sure your residuals are normally distributed. There's no pattern to the so basically what I did was I took the residual and plotted it against my predicted, and you want this scatter plot to look like complete noise. That's what a good regression would look like. So what you see here as tests are really tests of, are my residuals are they random, or is there if there is a pattern to the residuals? In other words, you see a line that you can fit through the residuals, then your regression might need tweaking or fixing. In this case, they look okay. So I can get away with those predictions, but for at least this sample, because it looks like the regression works. So let's summarize. Regressions are useful tools, but you have to use them with caution. Don't take small samples, throw in dozens of independent variables and expect the regression to do much for you. In fact, it'll give you results that can be more misleading than helpful. So learn to read a regression. It's a useful tool to have in your toolbox, which you can sometimes take out to see if there are patterns in the numbers you're looking at, and perhaps to make predictions. I hope you found the session useful, and thank you very much for listening.